Hello everyone, C. R. Sagarwal. Now a quick revision podcast on AS11. The topic is the effect of changes in foreign exchange rates. Right. In this accounting standard, we see what are the kind of transactions that are covered by this accounting standard or scope of this accounting standard. Recognition. In the recognition, we'll see initial recognition, subsequent recognition of exchange differences, and accounting of forward contracts. We will also see how to treat difference that arises with regard to changes in foreign exchange rates, right? This accounting standard. And question on this accounting standard is not much expected. It is asked exceptionally only 2 times it was asked. So very deep question cannot be asked. Still, you should be aware about, right? See, the scope of this accounting standard deals with the transactions which have been conducted in foreign currencies. For example, an Indian company sells goods to a foreign customer, right? For example, Airtel provides its services to a person who is sitting in US, right? Another is if Airtel is having its operations in US, so it must be having a branch in US. It must be having its assets and liabilities in US. So translation of those assets and liabilities into Indian currency, that would be the scope. And third kind of transaction would be forward exchange contracts. In order to protect against losses, companies go for hedging against these exchange rates. So forward exchange rate contracts are entered into. So this accounting standard applies to three kinds of transactions. First is transactions in foreign exchange. Second, translation of the financial statements of foreign branches. And third is forward exchange contracts, right? The main issue that arises in recording the effect of changes in foreign exchange rates are two. First is what rates should be taken for recording, and second, in case any exchange rate different arises, how to treat that. There are two issues: what exchange rate to take and how to treat the exchange rate difference in financial statements. Let us see. With regard to this, let us see recognition. There is initial recognition and subsequent recognition. Recognition means recording any transaction in financial statements like journal. So initial recording of any transactions like sale or purchase should be done by applying the exchange rate which was applicable on the date of transaction. For example, if Airtel has billed any foreign client, so what is the exchange rate today that should be used for recording the transaction? But day-to-day basis, it may not be feasible for the company to use different rates. So company may apply an approx rate which is continuing for couple of days or couple of weeks. So average rate may be applied because actual receipt will take place on the basis of contracted amount of dollars or foreign currency. Exchange rate is not going to affect the amount to be received or amount to be paid. It is just a recording. So initial recording should be done at either actual exchange rate prevailing at the time of transaction or average rate may be taken. Thereafter comes a subsequent reporting or translation. Means on the balance sheet date, there are assets and liabilities, incomes and expenses that are to be translated from foreign exchange to Indian currency. So those items which are monetary, for example debtors and creditors, they should be translated by taking the exchange rate prevailing on closing of the financial year, say 31st March, right? Thereafter, non-monetary items like fixed assets like inventory that require valuation. So their value should be translated into reporting currency. For example, rupee will be the reporting currency by taking exchange rate prevailing on the date of transaction in case of fixed costs, right? But in case of inventory items, the exchange rate that was prevailing at the date of determination of valuation of inventory should be taken. So this is translation of non-monetary items. Fixed assets on the date of purchase of the fixed asset and inventory on the date valuation is done, right? So subsequent transactions, one is subsequent reporting, one is monetary items, closing date. Second is non-monetary items, two types. Now third is contingent liability. So contingent liability should be disclosed by using the closing rate, right? So these are the three items that are to be recorded at balance sheet date. Now comes recognition of exchange rate difference. Means due to translation, due to actual receipt, there may be gap in exchange rate. For example, when you sold goods, dollar price was 80 rupee. When you received, the dollar price was 83 rupee. So there is 3 rupee benefit. So if there is any exchange rate difference with regard to any monetary items, that should be recorded as income or expense for the relevant financial year, right? But in case exchange rate differences arise concerning non-integral entities. Non-integral entities are those which are having their separate legal existence like subsidiaries. So the exchange rate difference should be transferred to foreign currency translation reserve account. It cannot be transferred to the parent company's account on year basis. It will be transferred only in the year of disposal of the foreign investment, right? Now come to forward exchange rate contracts. So if a company purchases or sells any forward exchange rate contracts, the premium paid or discount received, that should be amortized over the period over which the contract will be in application or contract will be in force, right? And in case any profit or loss is there due to exchange rate difference on account of such a contract, that should be transferred to the profit and loss account. So this is the translation. Now come to disclosures. So in financial statements, it is necessary to disclose the amount of exchange rate difference that is transferred to profit and loss account, right? And the amount which is accumulated in foreign currency translation reserve account, right? And another, if there is any change in classification of any foreign operation, so the nature of that change should be disclosed, right? So this is accounting standard on foreign exchange rates. Now come to accounting standard on government grants. This has already been asked in the year 2023. So there are rare chances of asking in the year 2023. Still, let's have a quick revision. So government grant may be received by any entity in the form of subsidy or cash incentive or duty drawback, right? So this it may be received by any company for doing any developmental work or for doing any work which is of public use, right? Generally, two conditions are there for recognition of government grant. First condition is that the company will ultimately receive grant. This is first. And second is the company will be in a position to fulfill all the conditions attached with the grant. Only then revenue from the government grant can be recorded, right? Now, government grant may be of two types and accordingly treatment will be made. One may be capital grant and second may be income grant. So there is capital approach and income approach, right? So far as the capital approach is concerned, it is with regard to assets. It may be received in cash, it may not be received in cash. So if government has provided non-monetary grant, for example, government has provided land at a cheaper price, right? So in that case, the actual cost should be recorded as the cost by asset. So grant would be automatically adjusted in the cost. But in case grant is received or asset is received at free of cost, in that case, asset should be recorded at nominal value only. Nominal value is a value which is not reflected in the total, but which is shown just like authorized share capital, so that readers are aware about this is the value of an asset received from the government, right? Thereafter comes monetary grant. Monetary grant means money is given by the government, right? If monetary grant is received by an entity, assets should be recorded at net cost, means actual cost minus government grant, that is net cost, right? But in case government has given full amount of grant, then asset can be recorded at nominal value only, right? Further, in case an asset is depreciable, In that case, government grant may be recorded as deferred revenue income, so that if company is charging depreciation on full cost of the asset, the additional depreciation is written off against that deferred revenue income, right? But in case grant is received with regard to non-depreciable asset like land, in that case the grant amount should be transferred to capital reserve, right? Capital reserve, right? So I explain again capital approach. Under capital approach, government grant may be received in two forms. First is non-monetary grant, second is monetary grant. So in case of non-monetary grant, the asset should be recorded at cost if there is partial grant, and nominal value if there is full grant, right? And in case grant is received for any grant is received in the form of money, asset may be recorded at net cost. If there is complete grant by the government, in that case asset may be recorded at nominal value. There is another method in case grant is received for a depreciable asset. So entity may record the asset at full cost and transfer that grant to government grant account. In that case, company will be charging P&L for depreciation on the full amount. So an amount proportionate to government grant will be recovered from the government grant account and credited to P&L account. So in this manner, P&L will be debited for net amount of depreciation only. But if government has given cash grant with regard to non-depreciable asset, or government has given grant in the form of promoter's contribution, that should be transferred to capital reserve, right? So this is treatment as per capital approach. So far as revenue approach is concerned, it is very easy. The government grant which is received for any past work done by the company should be credited to P&L account, right? Or this grant may be deducted from any expense related to that activity, right? And in case company has received grant in advance for example for the next 3 to 5 years, in that case only proportionate grant should be credited to P&L account, right? There are provisions regarding refund of grant also. In case company has to refund a grant related to any asset, so cost of the asset should be increased. If grant is received, if grant is to be refunded which was revenue, so it should be charged from P&L, right? Other things are not important. So this is all about accounting for grant, right?